Good afternoon, ladies and gentlemen. Let's just wait a moment because I can see 30 people have joined, but there's a lot more which registered. So let's just wait a moment. Let's give everybody a chance to join today's session. I can see some more people are joining. Let's just see if we can get everybody that registered to join today's session. All right, let's get started. So today, ladies and gentlemen, we're looking at correlations and we're looking at investor sentiment. Now, we are, of course, going to learn about different theories, different factors, different elements of correlations and investor sentiment, but I don't like education just for the point of knowing something. Here, as part of my webinars, I always like to learn something, to show something, to talk about something, but to make it relevant to how to use this information. Because yes, of course, I always say knowledge is power, but how can we use this knowledge in order to profit as traders? This is the point of today's webinars. Yes, we're going to start off with looking at what correlations are, what are the different types of correlations. But the main thing, ladies and gentlemen, is how can I use that as part of my analysis? Because in order for us to be successful traders, you have to be able to consecutively be able to predetermine how the price is likely to move within a specific period of time. So if, for example, you're a short-term trader, there's no point listening to, for example, analysts and listening to fund managers saying that in 2024, the US dollar is going to increase in value based on what we're looking at the value today. There's no point, because it's not about knowing how the market is going to move. It's about predetermining how the market is going to move within a specific period of time. It's more important for someone to say to you, in the next 5 minutes, this is how the price is going to move, rather than them saying, you know, in the next 5 days, this is how the price is going to move for a short-term trader. So it's about being able to do so on a specific period and being able to do so consecutively. So, of course, this is what we want to do as part of today's session. Yes, we're going to learn. Yes, it's definitely going to be educational. You're going to learn a lot about correlations and investor sentiment. But it's about how can we include that as part of our decision-making process, as part of our analysis to determine, yes, today, because of XYZ reasons, this is what's going to happen within the market. So this is what we're going to look at as part of today's webinar. We're not, unfortunately, going to have live analysis as part of today's webinar because the price movement in the market and the volatility and the momentum and the direction is unbelievable. Even as we started the webinar, in the last 2-3 minutes, I was opening and closing trades. So it's been an unbelievable day for individuals that are trading based on trend-based analysis. Maybe not so amazing for individuals such as individuals looking at methodologies such as, for example, mean reversion. But trend-based investors and traders are really loving the direction today. But we're not going to look at live analysis today. What we will definitely do, without a doubt, is show you how you can use different factors within the market which make up part of these two categories, correlations and investor sentiment, how you can do so and actually use indicators out there to determine how the market's going to move throughout the rest of the day. Because there's a lot of indicators which are based on the price. There's a lot of news and economic data which people can use part of fundamental analysis. Order flow analysis as well, very easy to get access to with the right tools. But the biggest price driver in the market, ladies and gentlemen, is actually investor sentiment. That is the biggest price driver in the market, because the sentiment of these large institutions, fund managers, strategists, and so on and so forth, their sentiment is making their decision on whether they're buying and selling. So this is one of the biggest and most important factors. But there isn't a specific indicator in regards to that. There isn't an investor sentiment oscillator, for example. But there are ways in which case we can use different factors to determine whether we're looking at a risk on or risk off sentiment within the market, if there's a high risk appetite or low risk appetite, for example, as well. So this is what we're going to be looking at as part of today's webinar. What I want to mention as part of this slide, these next two slides I want to get through as quickly as possible, because I want to start looking at correlations, investor sentiment, getting a good understanding of that, and again, going as quickly as possible to looking at how can we use it to open and close trades. But what I want people to understand as well in the next two slides is these webinars are here for educational reasons, for educational purposes. We're not here to give investment advice. We're very simply just providing a platform for individuals to get access to the financial trading markets, more specifically derivatives, spots, futures, and so on and so forth. But we don't give investment advice. What we do want to do, though, is give as much educational material as possible in order for you to be able to trade with knowledge, with experience, with expertise, and with confidence. A little bit about my background, because people a lot of the time ask me questions about, how long have you been trading and so on and so forth. A bit about my background. Yes, I am a trader, but I'm also a financial advisor. I originally started off as a financial advisor, actually, before I even started trading. That was in London. That I did for four years, just over 4 years, for a company known as Platinum, very well known in London. I'm a licensed financial advisor. I do hold a license in Cyprus. Also got a license in the UK known as CMAP as well. And I've been trading and in the financial service market for almost 10 years now. So this is a little bit about myself. Really, it's not important, like I said, to your investment. But what I want people to understand is use these webinars, ask me questions. I've even got somebody who's already asked a question. I'll read it in a moment. Ask me questions, talk to me, tell me about your experience. If there's something you're struggling with, let's talk about it, mention it. There is an option on the GoToWebinar software to have conversations, to ask questions, to send private messages. And of course, we'll look at all of this live. I've actually got a question already. Let me just quickly read. It's from a lady. Let me just quickly read it. Ladies first, of course. So she says, I'm trying to trade the trend, but today hasn't been very successful for me. So I'm guessing she's referring to the fact that I said we've looked at very strong volatility, very strong direction within the market, and trend traders are loving it, like myself. But she's not loving it, and she's actually saying she's unsuccessful today based on her trades. I'm guessing this individual has traded based on a trend, which is now no longer applicable and has changed today. And what she's now actually doing is fighting the trend rather than trading with the trend. So that's possibly your issue at the moment. Of course, we can have a one-on-one session and you can request that from your account manager. Or you can send us an email as well, and we can look at it in more detail, because I do offer one-on-one sessions and we can look at things in more detail. But I'm guessing, because we saw, especially on certain assets, a specific type of trend yesterday and a very different trend today. One of the most important things of trading is being able to very quickly alter the direction in which we're speculating. Okay, that's something very, very important. Now, at the end of every single webinar, we always do a poll. Very simple. The last poll, sometimes the polls are based on commodities, sometimes indices, sometimes currencies. Last time we actually did a poll based on the stock, which is the first time we've done so in a very long time. We looked at Nvidia. The question in the poll was, will Nvidia break 1,000 US dollars per stock? 83% voted yes. 16% voted no. The correct answer was yes. The most recent highs, if we exclude the price yesterday, was 1,064, just over. The most recent high, though, ladies and gentlemen, the current price that is, because the market hasn't yet opened, and that's not included in the pre-trading hours price movement, is 1,140. So we're looking at a very high price, one of the most expensive stocks in the world. If we're looking at blue chip, well-known stocks, it is the best performing in 2024, was also the best performing in 2023. So 83% said yes, 83% were correct. That is the majority. Most probably they were trading based on that, in which case most of the individuals were successful. So that's something very good. Thumbs up, like we've got here on the bottom right. And we'll of course do another poll today at the very end as well. We like to do polls, and we like people to speak with each other. We like people to ask questions. We like people to have conversations. Market correlations. What are correlations? A lot of people say to me, correlations, they're not 100%. Correlations, it really runs the risk of us trading with emotions. And that's a big issue. The fact that it's not 100% and the fact that it can risk you trading with emotions. People a lot of the time sometimes speculate that there is no such thing as correlations within the market. So people that tend to follow these lines and these paths and these theories don't understand what correlations are. Because a correlation isn't an indicator. It's not telling you how the price is going to move, but it's actually showing you the connection between one asset to the other asset. Now, even though it's not an indicator, what we can use correlations to determine is the line of influence of an asset. Also, we can use it as a checklist. When I was working with trade floors, when people were looking to speculate a buy, they always had a checklist, and it was a checklist of requirements. Now, a lot of those requirements were based on correlations, because it's basically saying, if this is happening in this market and this is happening in this market, what kind of domino effect is it going to have on the asset that I personally am trading? So this is a big factor. I've got a question. I've got two more questions. So I won't read them now. Let's look at the page first, because there's two questions, and then we'll answer the questions. So also, a lot of people, like I said, say, is there such a thing as a correlation? Or is it just market noise? Is it just people within the market giving inaccurate information? And to be honest, you cannot deny that there is correlations within the market. A correlation is based on statistics. It's not a theory. It's not based on investor sentiment, even though the sentiment is what's triggering the correlation. In regards to emotions and in regards to sentiment and trader psychology, that is something that can be debated. But when it's backed with statistics, because a correlation is only a correlation if it's backed with statistics. If it's backed with statistics, we cannot say that it's market noise, is something that doesn't really exist within the market. Now, what we do definitely look at is that the fact that there is very strongly correlated assets, and there's correlated assets which are weakly correlated as well. And you can actually go on to Google, you can type in correlation charts or asset correlation charts. I don't like giving people a specific website. They all look very similar, and it's basically a chart, and you can line between two assets and you can see exactly what level they are correlated. Actually, before we go through the bullet points, let's answer the questions. I've got 3 questions now, actually. One person said, if I can give just one trading tip, what would it be? We'll come back to that. It's not related to correlations. So I've got somebody who says, are there other information that drives stocks? If so, where can I find them? I have been trading Forex and commodities, don't know how to start trading stocks and bonds. Yes, 100%. And to be honest with you, we're going to look at the NASDAQ in a moment. What you need to think about is if you're going to start to trade stocks individually or if you're going to start to trade indices. In regards to that, we are going to look at an index, the NASDAQ. We are going to look at the line of influence and what is going to drive the price. So to be honest, your question is going to be answered later on. If it's individual stocks, we'll look at that as well. It's not within the PowerPoint, but at the end of the webinar, we also will look at that. So market correlations. Market correlations look at how assets throughout the market are linked. More specifically, the price of each asset changes depending on the other assets. So there's different types of correlations. We have inverse correlations and we have positive correlations as well. So we're looking at how these two assets, or it could be two sectors, two categories of assets, for example, it could be not necessarily gold and should we say Apple stocks, but it could be commodities and metals and the stock market. So it's not necessarily two assets, it could be two categories. How are the two linked? So you have inversely correlated, in which case if one price is going to increase in value, the other one will decline, and vice versa as well. If it's going to decline, the other will increase in value. So this is what is known as an inverse correlation. And then we have positive correlation. So we're going to look at examples of both. And this is where they move hand in hand. Now, keep in mind, derivatives and the real underlying assets are not correlated. They are 100% mimicking each other. So the price of one is derived from the other. When you're looking at correlations, the price of one is not derived on the other. It's just having that domino effect within the market. It's, you know, when you push one domino down, it hits the other domino, that falls, which will hit another domino, and that falls as well. So that's, you know, the domino effect. So it's not derived, one price of the asset is not derived from the other, but they are linked. Now, this is not a theory, it's based on statistical fact, which is measured based on a theory, the -1+1 ratio. Very simple. So the perfect correlation, just to give you an example of how it's based on statistics, the -1+1 ratio is the perfect correlation. So if one asset is increasing in value by $1, the other one decreases by $1, then that's known as a perfect correlation. People also use other theories as well. For example, a very well-known theory, it's actually being used more and more in today's market, especially within the stock market, is the percentage theory. So if one is increasing by 1%, the other one's decreasing by 1%, and so on and so forth. So it's not a theory, it's based on statistics. Yes, some have very high correlations, the other one have very low correlations. -1+1 is known as the perfect correlation. Some correlations are known to be strong while others are known to be weak. Also, the strength of the correlation can change depending on the market condition. So there actually was another question. I didn't answer that question. I mentioned to you there was 3 questions. Didn't answer that question very simply because it was about to be answered. So somebody said, what is the strongest correlation out there? And to be honest, yes, there is some which are traditionally known to be very strong. So for example, the Australian dollar, New Zealand dollar is known to be very strong. Also gold, silver known to be strong. Also the US dollar and gold known to be very strong as well. However, the strength of the correlation is likely to continuously change. So for example, in 2024, it could be to this level. In the second half of 2024, it could be to a completely different extent. Correlations are important for individuals who trade more than one asset, but also to use to determine how that price of the asset is going to change. Now, if you're building portfolios, and a lot of people that I speak to and watch our webinars, yes, they do build portfolios. Correlations are important because you want to mitigate risk, you want to spread the risk as well. But for individuals that are trading more than one asset, now actually this will answer the question at the very beginning, the first question. For one tip, now we don't give tips, we don't give advices or anything like that, but something that can help individuals is, you know, if you're trading two assets, you have to be careful with correlations. One of the main things is you have to ensure that they are not correlated. Why? Because some people may say if it's positively correlated, then it's okay. It's not, because you're fully exposed to that one asset and that direction. So if we're trading, for example, euro against the New Zealand dollar and euro against the Australian dollar, they're very strongly correlated, those two currencies. So if we're both trading that the euro is going to increase in value, for example, the issue is that if I'm incorrect, I'll be incorrect against all trades, both trades. If they're inversely correlated and I'm trading that the euro is going to increase in value, one will be correct, the other will be unsuccessful. So if you're trading more than one asset, you have to be cautious about correlations. This is why also we think and use correlations. In regards to what the individual said, if we can give something that's very helpful, if there's one thing beginners can take into consideration, and this is actually why a lot of new traders without experience sometimes are unsuccessful, sometimes they blow their accounts, a lot of the times they do, is because they trade too many assets. Why trade so many assets? People think if I'm trading more assets, there's more chances of a profit. If I'm trading more assets, I'm spreading the risk. You're not spreading the risk. If you're building a portfolio, yes, that is something that we do to spread the risk. But if you're not and you're trading, you're not spreading the risk. If anything, you're increasing the risk. It's like, for example, if I've got two sons, one of them is studying 1 degree and the other one is studying 10 degrees, the one which is studying 1 degree will be more successful than the other individual. Why? Because he's only concentrating on that one single degree, but the same applies to asset, that one single asset. Start off by trading just one asset, because your knowledge and your experience and your expertise and confidence will grow at a much faster pace. Doesn't mean you trade less, doesn't mean you're going to trade more, doesn't mean you're going to earn less either. Your trading will be the exact same, but you're just trading one asset. And ladies and gentlemen, this can be a massive benefit. Also, when you look at large trading floors, like I've worked with before, you will never get an individual who's, you know, buying different assets from different, you know, categories. You will have one individual, I should say one group, which are solely their duties is solely based on gold, and another group of people is only based on the technology market and the stock market. The other individuals are based on the defensive stocks, and so on and so forth. There's a reason why they do that. And, you know, why should we as beginner traders enter the market and from the very first day have that disadvantage? So yes, individuals building portfolios, and, you know, building portfolios can be great, 100%. You know, correlations are very helpful. If though we're trading and you're trading one asset, which gives you a big benefit, what you can use it, like I'm mentioning here, is also are used to determine how the price of the asset can develop. So how can you use it to determine how the price is going to change going forward? But before we start looking at that, because we're going to look at those steps where you sit down in front of your computer and you've got that checklist and you're going through the line of influence to determine how the price it's going to move based on correlations, based on investor sentiment, and then, of course, indications, the economy, and so on. So correlations. There's different types of correlations in the market. Some are weak, some are very strong. So there's risk-based assets, which are correlated with low-risk appetite assets. So for example, risk-based assets is the stock market. For example, could be the cryptocurrency market as well. Low-risk appetite assets, for example, is the Japanese yen, is, for example, the US dollar. The most famous within the market, sorry, I thought I was about to sneeze there. The most traditional, most well-known within the market, ladies and gentlemen, is gold. Now, this traditionally is very well correlated and a strong correlation, though in 2024, because of the very big changes in what people believe is going to happen to interest rates, there's not actually been big changes, but what people believe is going to happen with interest rates, there hasn't actually been that many changes, ladies and gentlemen. Sorry, that hasn't actually been that strong of correlations. However, to a certain extent, 100%, it is still correlated. So we have risk-based assets versus low-risk assets, low-risk appetite assets, that is. Then you have safe haven commodities, which are positively correlated. So for example, if the value of silver is increasing in value, it moves hand in hand. There's a positive correlation there with gold. Okay, again, over the past week especially, that has had a lower correlation, but definitely a very, very strong correlation. The only thing in the past week, it's not that it's lower correlated, it's just that it's having a lagging effect. Now, some people may say that, okay, that's a disadvantage. So not a disadvantage, that is one of the biggest advantages if you're having a correlation which is lagging, because that shows you that a specific price movement has happened. This means that I've got time now to trade the next lagging effect within the market. Then the stock market, stocks versus stocks. So the stock market overall is correlated. This is definitely something that we always look at. So for example, stocks in Europe are correlated with stocks in the US. Why? Because it's all based on investor sentiment, and it's all based on the investor sentiment towards that category, the stock market. Also, we can take into consideration not necessarily leaving the country, but staying within the country. For example, the S&P 500 and the NASDAQ is very strongly correlated. The Dow Jones with those two, though, is correlated, but again, to a much lesser extent. But this is a very strong correlation. Growth stocks versus defensive stocks, not defense sector stocks, which have been very, very popular over the past 12 months. We had a webinar based on those towards the end of 2023, and those over the past year have shot up for obvious reasons, sad reasons, but obvious reasons. So not defense sector stocks, but defensive stocks. What are defensive stocks? Defensive stocks technically are companies which, regardless of the economic conditions, do very well. So for example, even if there's a recession, those companies are still profitable and they don't see a dip in sales, or not as large as a dip in sales. Also, they tend to, a lot of the time, be paying a strong, very well dividend yield as well. This is also something for individuals to know about defensive stocks. Growth stocks are the complete opposite. More volatile, tend to perform poorly within recessions because they're more based on assets which depend on, high consumer demand, and also they a lot of the time don't pay dividends. But the price has a very high potential of upward price movements. This is the difference between growth stocks and defensive stocks. Euro and the pound very strongly correlated, very much so because their monetary policy, because the most traded currencies in the world, ladies and gentlemen, there's four. In terms of reserves, that is. We of course got the US dollar, we of course got the Japanese yen. Then we've also got the euro, and we've also got the pound as well. Now, if we remove the Japanese yen, because it's very uncompetitive in terms of its monetary policy, we're only left with those three: the Fed, ECB, Bank of England, and those three currencies. Now, if the most popular will always be the US dollar, okay? Now, if we're going to have a negative price movement on the US dollar, what tends to happen a lot of the time? Institutions, banks, central banks, also large companies, they'll lower their exposure to the US dollar and they will increase exposure to the euro and the pound. So this is why those two are correlated, because especially now that Japanese yen is out of the equation as well, there's a very strong correlation with them because of their effect based on the US dollar, and also based on the fact that the Japanese yen has completely been removed from the picture. Australian dollar, New Zealand dollar, largely to do with the region and geographic purposes. And then of course we've got cryptocurrencies, which are very similar to stocks. We tend to see not just one cryptocurrency increase and then everything else declining. We tend to see them move hand in hand. Now, before we start moving on to looking at the market, we are going to look at an indication here. But before we start to look at the market, look at examples, look at how to build that checklist and what is that line of influence for these assets to use alongside, the correlations. Something which is very big influence in the market, very few people use, is investor sentiment. So the power of determining the investor sentiment and where there is demand. One of the biggest price drivers within the market is investor sentiment. However, this is also one of the hardest to determine. To determine investor sentiment, investors monitor the following: color square pie charts. If you type that in Google, you'll be able to see exactly what I'm referring to. We've got an alternative as well. For example, here, instead of seeing square colored pie charts, we can have it as bars like so. Price sentiment indications, especially on larger time frames and medium-term time frames, especially for traders, medium-term time frames is extremely important. What percentage of the whole category is witnessing similar price movements? So instead of looking at color square pie charts, which can be more difficult for beginners to understand, I've opted for this method here, but you can of course use that method as well. The information is the same. So here, ladies and gentlemen, I've got the most traded assets within the futures market. Of course, you can change this. This is taken from a website which is known as FinViz, but of course you can use alternatives. That's absolutely 100% fine if you wish to use alternatives. But if we're looking at here, this was only taken from Monday, by the way. What can you see? Okay, it's very simple. It doesn't take a market analyst or financial advisor or an experienced trader to see what's happening. We can see here the market's going very well. If we're looking at here, ladies and gentlemen, there's 25 assets. From those 25 assets, we have we've got 30 assets, and from those 30 assets, we have less than 10 which are declining in value. And for example, if we look at the Euro Stoxx 50, it's not really declining in value either, 0.06, nothing to necessarily brag about. So we have to take that into consideration. So we can see here 90% of the market, 90% of these assets are increasing in value. If we're looking at the US dollar as well, which is a safe haven asset, it's significantly decreasing in value. We're looking at a decrease in value by 0.32%. So why is that important? Very simply because it's indicating that there's a high investor sentiment. There's strong positive sentiment towards risk-based assets. So that's something for us to take into consideration as well. Most of the market is green. Most of the market is performing well. Risk-based assets are performing well. If we're looking at the US dollar, it's decreasing in value, which is showing that there's high, strong sentiment within the market. So just by looking at, for example, that, what do you think is going to happen to the stock market? What do you think is going to happen to the stock market? I'm pretty sure most people will believe the stock market will be seeing a positive price movement. And yes, it did see a positive price movement. And this can very easily, we don't need to complicate it. Very easily we can see just by looking at this. Today, most of the market is increasing in value. And there's, yes, poor sentiment within the market, increasing in value, and also sentiment indications and assets which are based on sentiment. I've got a couple of questions here, but I'll try and answer these in a moment. Some of these are based on sentiment, based on safe haven assets. And we can see based on that, ladies and gentlemen, that of course the prices the stock market of the S&P 500 and Nasdaq are increasing in value, and it's 100% understandable. It's not rocket science. So this is something you can take into consideration. Number one, we're speaking about the correlation because we're looking at, for example, US bonds. Here, if we look at US bonds, bonds are lower. If bonds are lower, it means there's higher risk appetite, not bond yields, but the bond value. So there's higher risk appetite. We're also looking at the US dollar. Again, the US dollar is down, so there's high appetite within the market. And again, everything is almost green. Almost everything is green. So we can really see here how that's going to drive the market. Now, I've got a question here, and somebody's saying, can we look at what we're seeing today? Yes, we can. Let me just bring it up for you, and I can show you. And keep in mind, this is something which I completed yesterday, so it's not based on today. And even if we look at it today, this is something based on yesterday. If we look at today, it's the complete opposite. Almost everything is red, ladies and gentlemen. Almost everything. And also, the oil prices of oil is increasing, both crude oil, Brent oil. That's negative for the stock market. Why? Because it has a bad effect on inflation. It causes upward pressure for inflation, which very simply means we're not going to get interest rate cuts and interest rate adjustments. We're not going to get quantitative easing programs. And also, that's definitely negative for the stock market, definitely negative for consumer demand as well. So, number one, we can see that everything is red. Number two, oil is increasing in value. Both crude and Brent oil are increasing in value. And the US dollar has increased in value as well, ladies and gentlemen, which shows a poor negative sentiment within the market. Now, if I go here and bring the MT5 up, here we're looking at the US 100. So we're looking at the Nasdaq, ladies and gentlemen. Let's go to a 5-minute time frame. Look, guys, it's been declining all day. And in the last 5 minutes that I've been speaking, looking at sentiment, it's declining as well. So you can see here exactly how I'm using it, why I'm using it, ladies and gentlemen. So it's not just theory. I want people to be able to use and take this information, to use it as part of your analysis, to be able to look at it and say, this is how I'm going to trade within the market. So this is, for example, FinViz. You can use another provider. This is something that you can use. Number one, we're using correlations and thinking about how certain things has a domino effect within the market. But more simply, looking at it, if 90% of it is green, what's that telling us? 90% of it is red. Again, what is it telling us? So this is the square pie chart. Now, the second point here and the third point, this is something that we're going to look at in a moment as well. So the bias, the day's bias, so the line of influence, This is something very important when we're trading. What is that asset's line of influence? This is also why we shouldn't continuously all the time change assets as well. Because if I trade the NASDAQ, I know what its traditional value is, what its intrinsic value is, if it's trading overbought or oversold, and I know the line of influence. I know what I need to follow to determine how the price is likely going to move. You know, maybe sometimes I'm not correct. This is trading. That's absolutely fine. Even if you're a beginner trader, make sure your reward to risk ratio and success rate is in line. And even if you only have a 50% success rate, you can still be profitable. So is there a clear line of influence? Establish this before monitoring the signals. So look at the line of influence, look at the correlations, and then look at signals, then look at technical analysis. Ideally, you don't want these to be conflicting. You want them to move hand in hand, okay? So if you've got the line of influence telling you that you should be buying, but the signal is saying you should be selling, that's not really what you want to see. So that may, for example, indicate mean reversion, sideways price movement. It may indicate up, down price movement throughout today's session. Some people may want to just stay clear of the market altogether when that happens. Or it could indicate a change of trend as well. Consumer investor sentiment indicators are lagging to have a positive statistical ripple effect on the asset. So what are we saying here? Consumer and investor sentiment are lagging indicators. So for example, if you look at yesterday, we look at the consumer sentiment indicator. There's also an index for investor sentiment. They're lagging. They're based on last month. It's not going to have an effect on this month. It's based on last month. So it tends to have a poor correlation and a poor effect. Can't be used to a massive extent. So developing the day's bias. Let's look at developing the day's bias. So let's look at gold. Let's look at the US stock market. Let's look at the euro as well. We'll look at other assets as well. So if we look at gold, what are we going to check? Number one, the US dollar. It's inversely correlated. So if I want to speculate that gold's going to increase, ideally I want a poor US dollar. Then we've got silver, positive correlation. So if I want gold and speculate that gold's going to increase in value, I want silver to increase in value as well. Commodities, same scenario. Ideally, I want commodities to be up as well. Also, that creates inflation. I want inflation to be up because it's about developing that line of influence, developing that correlation. Because gold is used as a hedge against inflation. So if commodities are up and inflation's up, of course, that's a big factor. Then the stock market and bond yields. If bond yields are up and the stock market is down, it is an ideal scenario to indicate low investor appetite, which again is positive for gold. So this is what I'm going to do while trading. I'm monitoring these. I'll monitor the US dollar, silver, commodities, inflation, the stock market, and bonds. Now, not all of the time, 100%, there always will be the same direction, but I want most of it to be. Then US stocks. If you're looking at US stocks, first, especially because the European market opens first, I want EU stocks to be up in value. I want UK stocks to be up in value. I want the US dollar to be down because that indicates that there's a strong investor sentiment within the market. I want the US stock market as a whole to be increasing in value, not just for that one stock or that one index. So if I want to buy a stock, for example, the Alphabet, I'll wait for when the NASDAQ is performing well. Not necessarily just go and buy it straight away. I want the NASDAQ to perform well as Alphabet perform well. That also applies to other stocks. So for example, if I'm trading Adidas, I want the DAX to also do well. US bond yields. The higher bond yields are, the more pressure there is for the stock market. And then of course we look at individual components. Within these indexes, there's components, there's individual stocks. So if all of those are increasing in value or a large percentage, then again, that's another indicator. And then the ultra main risk-based asset, cryptocurrency. So cryptocurrencies are increasing. Again, big indication on sentiment there. If we're looking at euro, we're looking at the pound, the US dollar, the EU stock market, and of course EU bonds as well. So very similar scenario there. Now, what I always say, and what is very well known within the markets, is when we're looking at the market open, there's a theory out there, ladies and gentlemen. Now, sometimes it can differ, but it's more or less the same. Some people say 40 minutes, some people say 30 minutes. But if the price isn't lasting more than 30 minutes, as soon as the market opens, so not later on in the day, as soon as the US stock market opens, which is here, at this point here, ladies and gentlemen, if it's not lasting more than 30 minutes, then it's not a trend. And it's not an indication of sentiment, and it's not an indication of this is where investors are driving the market, okay? If it is moving for 45 minutes, 50 minutes, 1 hour, then yes, it is an indication. And this is an example. This was an example from yesterday as well. So the impulse wave, the price declined from here all the way down to here. It was a decline of 0.45%. But thereafter, the upward price movement was 0.28. So within 30 minutes, it lost. So within 30 minutes, it declined 0.45% and then increased up 0.28%. So there was only a difference, ladies and gentlemen, of 0.17%. So it didn't maintain that direction, that momentum. It's an indication that that's not the sentiment in the market, that there's not poor sentiment in the market, or not yet poor sentiment within the market. Also, I mentioned that you can use sentiment lines. Two very well-known sentiment lines is the 75 bar, which is the red here, exponential moving average. So you can see here 75 bar EMA, or you can use the green here, which is the 100 bar SMA. So there's a difference there between the two. So you can use those for sentiment within the market. But let's develop the day's bias. Let's understand that correlation. So here we're looking at the NASDAQ. First things first. Here I've got the 25 most influential stocks within the NASDAQ. Now, some people say, well, you know, how are you determining that these are the most influential stocks? Because I'm basically within the NASDAQ, which has 101 stocks. I'm looking at every stock which holds more than a 1% of that fund, or 1% of that portfolio. So that's how I'm determining the most influential. Altogether, it's 25. Sometimes it goes to 24, sometimes it's 23, sometimes 22. Yesterday it was 25. Today, more or less, will be about the same. So, number one, when the market opens, I want 70 or even better, 75% of those to be increasing in value if I want to speculate the price is going to increase. If I'm speculating the price wants to, that I want the price to decrease, I want 70 or even better, 75% to be decreasing in value. Number two, look at these stocks before the market opens. Go to Google. The market has actually already opened, which is a shame. Otherwise, I could have showed you an example. Sorry, I apologize. I do have an example here. So, ladies and gentlemen, here we can see the price of Apple stocks. So I've just gone to Google and I've typed in Apple stocks. I can do a review just for an example as well, actually. So here I'm going to do Apple stocks. There we go. Sorry, apologies, the market hasn't opened yet. So I look at Apple stocks and you can see here Apple stocks are up 0.12 cent. So 0.063%, very little, or 12 cents, either of the two. So I will go through all of these and I will check this, okay? In pre-trading hours, is the price increasing or is the price decreasing? If 75% of them are pointing in the same direction, it's an indication. Whether that's up or down, it doesn't matter. Then when the market opens, I will keep looking at this for the next 30 minutes, and I'll be seeing if the NASDAQ is able to hold momentum for 30 minutes. just over 30 minutes. If it's not, then I can't guarantee the sentiment. Then I'm also looking at the US dollar. The US dollar is declining. I'm also looking at treasury yields. Treasury yields are also declining as well. Sorry, apologies. This is, yes, treasury yields are also declining. So that's positive for the stock market. The US dollar declining is also positive for the stock market as well. So let's look at our list here. Bond yields are down, that's positive for the stock market. The US dollar is down, that's positive for the stock market. If we looked at the components, most of the components were increasing in value. Yesterday, if we looked at the second most influential component, which is Apple, a massive increase, 1.58% before the market has even opened. This is the fourth indication of the price increasing. The only indication of the price decreasing was that EU stocks were down and UK stocks were down. So I've got a 50-50 scenario here, but more of indications that the price is going to increase. Now, as soon as the market opened, the price decreased in the next 20 minutes downwards by 0.45%. A lot of people would be thinking, great, this is a trend. It's going to continue to decline. The Nasdaq's too expensive. Everybody always wants an excuse to say that the Nasdaq is too expensive. The clients are going to speculate in that direction. Whereas when I actually look at the market, bond yields are down, the US dollar is down, components, 70% of the components are increasing in value, and also the most influential stocks before the market is even open are very, very high as well. So there's indications there that actually we're not guaranteed to see downward price movement. What happened thereafter? Anybody that was trading here, by the way, and was trading at decline would have been unhappy yesterday. Would have been happy today because it's much lower than this price, but unhappy yesterday. What happens after that? Up, down, up. At the end of the day, it ended at the highest price seen throughout the whole day. So you can see exactly how I'm using this to determine and help me with my analysis, okay? Because otherwise, if I didn't have this, I would have been saying it's a breakout, a lot of downward price movement, straight away everybody's selling, so the price is going to decline. It didn't really turn out that way. Actually, as it declined, if we looked at this and started to say, actually, I'm going to buy because of this information, the price increased all the way up to here. And that's where it ended. Yes, it declined. There was a strong decline here, but at the end of the day, it ended up here. So you can see how I'm using the correlations and investor sentiment to assist. Also, we can use it for slightly longer term as well. And I want to show you this on the longer term, not show you just one session, one day and say, it works. Let's look at this, for example. This is the price movement between the 2nd of May all the way up to the 16th of May. This is the Nasdaq again. Look at this amazing upward price movement, amazing upward price movement. No indications here at all. But I'm using the correlations. I'm using my line of influence. Okay, so here, bond yields. Bond yields have been declining, ladies and gentlemen. So these are the bond yields here. So you can see downward price movement. You can see from the 1st all the way up to the 15th, ladies and gentlemen. Look at this downward price movement. Okay, let's look at the US dollar in that period. The US dollar, it was soaring downwards. It was absolutely collapsing. So this is another aspect as well. Lower yields, lower US dollar. Both of them are positive for the stock market. If we looked at EU stocks in that period, they were increasing. If we looked at UK stocks, they also were increasing as well in that period. If we look at components, 75% of components were increasing in value. So very clearly, indication of upward price movement for the Nasdaq. Indication of upward price movement for the Nasdaq. Up, up, indication of up. Price movement, look at this upward price movement. Amazing, lovely upward price movement. And also we can take it slightly further and look at the line of influence and look at company earnings. If we look at Apple, if we go back as well, you'll see here, Apple is the 2nd most influential stock. Almost 8% of the index is made up of Apple stocks. And if we look at Apple earnings, which actually took place here on this red line, you can see there were 1.5% higher earnings, and revenue was 0.33% higher. So they beat expectations, which is positive as well. Another indication for a buy. So you can see here as well, this is exactly how we're using correlation, how we're using them as an indication. Then we can look at the chart. This is the exact same chart as this chart. Then we can look at the chart and say, let's add indications. I want to buy, I want to speculate that with price movement. Let's add the indications now. So this is a 1 hour time frame. So really we're looking at intraday to actually swing trading, more than anything else. But of course you can do something similar with 30 minutes and other time frames as well. So if the price is above this red line, which is the 75 bar exponential, like I said, this is a sentiment line. It's indication of sentiment. So if it's above this, we're looking at only indications that the price is going to increase in value. Plus, we're doing so anyway because of the bond yields of the US dollar, of earnings, of EU, UK stocks, and so on and so forth. But this is a technical based indicator. Then we're looking at crossovers. So we had the crossover down here. We had an upward crossover here. We had an upward crossover here, an upward crossover. We had an upward crossover, upward crossover. All of these are upward crossovers. We had another upward crossover here. So all of these are indications that the price is going to increase. So each time we're within an upward crossover, we're taking into consideration a buy. Can see a question, I'll answer it in a moment. So what am I very simply doing? Each time the price declines, so here we're looking at the decline. Ideally, I want that even though it's retracing and declining, we're still looking at a higher low. So it's only a retracement. If it's a lower low, it's a different scenario because potentially that's loss of momentum at end of trend. So what am I doing is I'm very simply taking the high of the retracement and the low of the retracement, and I'm drawing Fibonacci retracement lines. As soon as it crosses above 65, which it does here, I speculate upward price movement at the breakout. Same thing here as well. That's the high, retracement low. Still above the 75 bar, and we've not gone to a lower low. We're still on a higher high here, ladies and gentlemen. So I've drawn between the high and the low Fibonacci, 65 here. As soon as it crosses above, speculate upward price movement. At 65 again, speculate upward price movement. 65, speculate upward price movement. Again here, 65, speculate upward price movement. All of these trades would have been successful because I'm trading in the direction of the trend, following the trend as well. So you can see here exactly how I'm using it to help me trade. Here we're looking at gold. So bond yields are down. The US dollar is down, both very strongly correlated. EU stocks, UK stocks, also US stocks were down, ladies and gentlemen. Silver was up, okay? Silver was up. So as the price is declining, I'm actually saying everything's indicating that gold's going to increase in value. Silver's already increased in value. I think gold's going to increase in value. Maybe it's just having a lagging effect. So I take that into consideration. If we get an upward crossover here, or even better, if we cross above the 75 bar exponential moving average here, which is an even better entry, we speculate upward price movement, and we're backing it up by looking at these correlations. And by the way, just to show you the correlation between gold and silver, look at this price movement. This is gold here, and this is silver here. Look at this. This is sideways, but then drop. This is upward, but a drop, then upward, upward again, then up, down, up, down, up, down, with an upward slope. Same thing here, up, down, up, down, up, down, with an upward slope. Very, very simple. Very, very clearly correlated as well. Now, let's very quickly have a poll, ladies and gentlemen. We've got two polls here. Let's do the first poll, and then we'll do the second poll. So do you use crossovers? So do you use moving averages and crossovers? So, and I'll answer the questions in the meantime. In my experience, the US market open heavily influences the price of commodities which trade much earlier than the US market opening. Is it a good idea to wait until the US market opens to see the trend is sustaining? Yes, definitely. Also, I said at the beginning of the webinar, the benefits of trading only one asset. There's also the benefits of trading one asset, only one session. So every single day I will trade, for example, the NASDAQ, and only in the US session, and only after 30 minutes, for example, of when the market opens. This is just an example. But yes, to answer the question. So 100% of everybody that answered said they do use crossovers. So that's good to hear. Very last question. This is the poll. This is the main poll, actually, the main event that everybody, of course, wants. And I'll confirm what people think. I want everybody to answer this question. Will the NASDAQ end the week lower or higher than the current price? Everybody needs to answer this question, ladies and gentlemen. Everybody. And I have 50 people that have answered. No, I need everybody answering. And I'll confirm the results. The results are very interesting, very interesting. I need a few more people to vote, ladies and gentlemen. We're not high enough. So will the NASDAQ end the week lower or higher than the current price? Guys, we need more people to vote. I only have 63% of viewers have voted. A few more seconds, ladies and gentlemen. 5, 4, 3, 2, 1. So let's end the poll. We have some people voted end higher. Some people said voted end lower. 60% of voters said that they believe the NASDAQ will end the week higher. 40% said they believe the NASDAQ will end the week lower. Let's see. We'll look at it in our next webinar next week. We always look at the poll and see if voters were correct or if they weren't correct. Last week they were correct. It was about NVIDIA. This time we're looking at the NASDAQ. Let's see if voters were correct. So let's end today's session. Trade safe, trade responsibly, as always. I will leave the webinar open a couple of minutes, just if anybody has any questions. Otherwise, we'll end the session. Let's see if anybody has questions. Actually, I can see most people are leaving. So let's end the session, because by the looks of it, nobody has questions, which is good also, because it means all questions were answered from the presentation. Though, ladies and gentlemen, in the meantime, trade safe, trade responsibly. Somebody's put their hand up. Maybe he has a question. If you do have a question, please write it so I can see what the question is. There we go, so I can see a question. I've got somebody says, the color square pie chart gives conflicting outcomes. Look, you'll never get, well, you can actually, but it's rare that you're going to get everything in the red or everything in the green. But you're looking at the majority, okay? And also you're looking at which ones are correlated. So again, if I go to Google, we go to, again, FinViz, you know, yes, I'm looking at the market and saying, you know, almost everything is in green, in red. And also these here that are in green, they're just about in green as well. So that's also something to know. But we're looking at, you know, correlations. So for example, the New Zealand dollar's down and also the Australian dollar's down. So there's a correlation there. So when I'm looking at trading, for example, the New Zealand dollar, I'm also saying to myself, all currencies are down other than the US dollar, but also the Australian dollar's down. And there's a correlation there. So you're not going to get everything 100% red or even everything 100% green, but you can use this definitely as an indication. And in addition to this, you're also using that to help you understand the correlations as well. That's a big factor. So hopefully that answers the question. So let's end today's webinar, and we'll speak again in our next webinar, which is next week on Tuesday. And we'll look at what happened to the NASDAQ and if people were correct. So let's end and close today's session.